Hello, everybody. My name is Pat McCann. I'm a research analyst here with Noble Capital Markets. I'm joined today by Kevin Chin and Alex Cuppage from VivoPower. Before I hand the floor over to them, just want to let you guys know if you do want to ask a question, go ahead and put that in at the bottom of your screen. There's a little Q&A box, and we will get to as many of those as possible at the end. So with that, I will hand the floor over to Kevin and Alex.
Thank you very much, Pat. My name's Kevin Chin. I'm the Chairman and CEO of VivoPower. Welcome to this presentation. Thank you all for joining. My colleague Alex Cuppage is the Chief Investment Officer. What we're going to go through today is VivoPower's transition to a digital infrastructure partner, delivering powered AI data centers for sovereign partners and hyperscalers. Quick glance at the company. So market cap's around the $40 million mark, founded in 2014, NASDAQ listed since 2016. We're headquartered in London. In summary, we are becoming a digital infrastructure company with access to sub 5 cents per kilowatt hour powered land, operating in select sovereign markets where we have deep connectivity. Our business model is to acquire, develop, build, and own AI-ready data center infrastructure delivered to powered shell level. We don't take the technology risk aspect, and we're not an operator. Our powered shells are leased to hyperscalers, sovereign governments, neoclouds, and enterprises under long-term rental agreements. And how we make money is in three ways. Number one, we permit and energize brownfield land. Number two, through development profits. And number three, through long-term rental income. Our land basis typically ranges from between 50,000 to 500,000 per megawatt, with sub $10 million per megawatt build costs and lead time to energization of 12 months. Very importantly, we avoid dilution by refinancing our stabilized assets, which releases development gains that we recycle to fund the equity tranche of further developments. And our typical development to refinance capital cycle is 12 to 18 months, and our return on equity normally well exceeds 2 times. In the last few weeks, there have been a number of significant developments with the company. The largest one is the acquisition of OGDC, which is a leading AI data center infrastructure developer. And it has 291 megawatts of powered sites in Finland that has sub 5 cents per kilowatt hour renewable energy. And it's very highly strategic location. And this is expected to close shortly this month. My colleague Alex is one of the co-founders of OGDC. And I will pass over to him with respect to the next slide. Alex, thank you. I hope you can see that clearly.
Yeah. Hi, everybody. Thanks for taking the time. In terms of what we do, we are a fully vertically integrated data center platform. So what does that mean? It means that we acquire brownfield lands. We permit that land for data center use. We energize that land with power agreements with the national grids. We design and construct the data center. We do that through a strategic partnership through a group called CTS, which is the leading European and GCC data center construction company. They're able to construct data centers at about 75 to 80% of the cost of the market. And most importantly, they're able to deliver up to 120 megawatt data center inside 12 months, which is absolutely critical if you were to secure a binding agreement for lease from one of the hyperscalers. We then, once that data center is leased up, we then take those cash flows and we put them in a permanent capital vehicle. We see AI data centers as the oil fields of the future, so we never want to sell those cash flows. So our goal is to keep those cash flows in perpetuity. We make money in 3 different ways. The first is on the land. Because we're buying brownfield lands and we're energizing that land, we're typically holding the lands at somewhere between 50,000 to 500,000 a megawatt on our balance sheet. Our public market peers are typically valued somewhere between 3 to 12 million per megawatt. So we're making money on the land. We make money on the build because we're delivering it faster, cheaper, better than the competition. And then what we're looking to do is make money on the refinancing, where we release capital that we reinvest back into the portfolio. So in a typical model, we take $1 development equity and we turn that into $1.50 to $2 of free cash flow that we're able to go out and build new data centers. If I was to translate that into megawatts, if we develop a 100 megawatt data center, that will deliver another 300, that will deliver the equity needed to develop another 300 megawatts. And then if we go through another cycle, the free cash flow that develops the 300 megawatts will generate enough free cash to develop a gigawatt. And we think that's super important to have a sustainable business model to build a large scale portfolio. We are focused outside the US, and we're typically trying to look for geographic regions where, first of all, the government, the sovereigns, are putting a flag in the sand to say we are betting the next 100 years of our economy on AI and digital infrastructure. The second really critical element we look for is we are buying land where the input power cost is sub 5 cents a kilowatt hour. And if we look at our current portfolio today within Finland, Norway, and Abu Dhabi, our typical input cost ranges between 2.5 cents to 3 cents a kilowatt hour. Passing back to you there, Kev.
Thank you, Alex. So as of today, our current portfolio has a total capacity of 358 megawatts. So in Finland, through OGDC, we have 291 megawatts. In Norway, we've acquired a site that's 42 megawatts. That is generating currently 30 mil of revenues, 10 mil of EBITDA through co-hosting, but that can pivot very quickly to AI use cases. And last but not least, in the UAE, we have 25 megawatts in tandem with a strategic sovereign partner locally. Just moving on to the next slide. So in terms of the value chain for data centers, our view, as Alex has articulated, is that powered land is what is scarce and most valuable in the value chain. And our model is to acquire and or originate to build to powered shell level, and then to rent these out pursuant to long-term agreements with hyperscalers as well as co-location operators. And typically these leases are for north of 10 years. Again, as Alex was mentioning, in terms of how the market looks at these businesses is on an enterprise value to megawatts under control basis, as well as on an enterprise value to EBITDA basis. You can see there that there is a sort of wide range of multiples depending on the maturity of each business, but some of the names there you would have seen: Iron, Fermi, Applied Digital, CoreWeave, amongst others. In essence, if you have a hyperscaler lease in place, the market typically values you at a median of about 10 times EV to megawatt. I think this is well understood by most in the market that hyperscalers account for the majority of demand. There is an arms race at the moment amongst them to secure powered land around the world. And in the regions that we're focused on being the Nordics, the Middle East, including the UAE, as well as parts of Asia, there is strong, inbound inquiry and appetite, as well as deals that are being done with hyperscalers. So what are we becoming, and what is our business and economic model in essence. So we're becoming a bricks and mortar growth business with a high reinvestment rate of return. And the flywheel that we're seeking to execute on and perpetuate is number one, to secure the powered land. And that is to interconnect phase A and then B to energization. And that's where disciplined CapEx investment comes into play, where we build the powered shell through partnering with tier one contractors and seeking to complete within 12 to 18 months at a 20% lower cost than sort of market rates. Then we enter into long-term leases, ideally on a pre-lease basis with hyperscalers. And as I said, that's typically 10 plus years, often seeing 15 to 25 years now. Once it's leased, then we're into stabilized asset phase where there's cash generation from the rental income, and we're able to refinance the assets with long-term low-cost debt. And what that does is to release capital for reinvestment into subsequent developments. So the attainment of asset stabilization phase really drives substantial equity uplift. And as mentioned, that capital can be recycled every 18 months. This is an illustrative example for 100 megawatts where the net lease rate, and this is conservative based on what, again, the market is doing right now, a net lease rate of 130 US per kilowatt per month translates into 125 million on an annual basis. The total development costs, and we've assumed this is 9.5 million per megawatt for a 100 megawatt site is 950 million. And we can finance that with 80% debt, 65% senior, 15% mezzanine, and the equity check is 20%. The equity we can either fund through what's on our balance sheet and or through partnering and joint venturing with strategics, and the strategics could include sovereign wealth funds, sovereign nations, sovereign families in certain jurisdictions, and or with institutional infrastructure investors. Again, what we're seeing in the market now is that if you're able to secure a pre-lease with a hyperscaler, then in some cases you're potentially able to get 100% development finance and obviate the need for any equity component in these developments, which is obviously, the first prize from a financing standpoint. In this example, to the right, you can see the development finance stack that I just went through. Once the data center is built and stabilized, the release of equity is north of $1 billion, and this is at a cap rate of 6.8% gross, which again is conservative. And what that translates into is north of 700 million of excess cash released to reinvest into the next development projects. So 700 mil, assuming that that represents 20% equity in the next developments, translates into almost 400 megawatts of development, and without needing to raise further capital. So this is an important slide to showcase, how our business and economic model works. As I mentioned, our initial focus has been on certain parts of Europe, specifically the Nordics, which have quite a number of natural advantages, including cold climates, very low cost renewable power, as well as the GCC, and that specifically is the UAE and Saudi Arabia. Amongst our investor base today include members of the royal families of both Saudi Arabia and the United Arab Emirates, and they've been very helpful in terms of our access to sites in the Middle East, and we're partnering with them on building out powered land. As I mentioned before, the Nordic markets are very strategic, and they have outperformed established hubs in Western Europe for power costs, as well as grid connection speed. And for that matter, they've also outperformed rest of the world. One of the key advantages is that the average grid connection lead time is just 1 to 2 years, particularly in Norway and Finland, whereas in other markets, in some cases, going out to 10 years now. There is a lot of activity in the GCC, and Alex has just returned from there. I might pass the baton back to you, Alex, just to talk through some of what you're seeing there, which is set out on this slide.
Thanks, Kev. I think the GCC is a really, really interesting market. If we kind of look at just cloud storage as with the benchmark being the US, the GCC is like 98% less data storage capacity today. However, there is definitely an AI race between Abu Dhabi and Saudi, and that's mainly between their government-sponsored entities, between G42 in Abu Dhabi and Humane and Alat in Saudi Arabia. And they're pumping in tens of billions of dollars a month into AI, both into the data storage capacity, the application layer, and physical AI. As Kevin mentioned, we feel very fortunate that, both existing and incoming investors are from the upper echelons of sovereign society in both nations. And the reason we really like this region is whichever way we look at it, Saudi and Abu Dhabi are going to become world leaders in AI services. They have an abundance of land. They have very cheap power input costs. So the asset that we bought in Abu Dhabi 2, 3 weeks ago, the input cost in that is 2.5 cents a kilowatt hour. It's a difficult place to do business, incredibly difficult as a foreigner. But I think the first Abu Dhabi deal that we've done where we secured 25 megawatts, no foreigner has been able to buy more than 6 megawatts direct, but we were able to do that because it was a JV with the brother of the ruler of the UAE. And we are currently developing plans there where we can take that from 25 megawatts to 100 to a gigawatt. And that gigawatt will be somewhat of a campus, which will see Vivo also acting as the strategic partner to bring in, advanced manufacturing, leading biogenetic companies, etc. They will build a premise around what we're proposing to do in the region.
So we have a very clear 10-year strategic growth plan. Over the next 3 years, we want to build out to 2 gigawatts. We don't want to be everywhere. We only want to be in markets that are strategic, where we have deep connectivity at sovereign level. And our goal is to get to $1 billion of annual revenues and north of 200 million of annual operating free cash flow, and to build out the AI native agile growth architecture that we need to scale. And over a longer horizon, we believe we can get to 20 gigawatts. In terms of the team, the OGDC team include Alex as Chief Investment Officer and Shane Whelan as Chief Real Estate Officer. They both joined our leadership ranks. Shane, who's based in Dublin, has 20 years of experience and relationships with hyperscalers such as Google, AWS, Meta, and Salesforce. And I'll just point out on the advisory council, Philip van Wolfen is also one of the co-founders of OGDC. He's going to be an active member on the advisory council and has deep connectivity in the EU region in particular. That's it, everyone. Again, thank you for tuning in. Happy to address any questions.
Thanks, guys. Yeah, we do have some questions. First question is, I believe you have a spin-off upcoming. Could you talk about that a little bit and the timing of that?
Sure. So we are spinning out our electric vehicle business, Tembo, and that's been a protracted process with respect to getting filing of the F4, but that was finally executed upon just prior to year end. I think it was December the 29th. So what that means is that the SEC's got a fixed period to provide their commentary. We expect that to be any day now. And based on typical timelines from here, we anticipate finally going public with that spin-off towards the end of March this year.
Got it. And then what about is it Carrot Digital? Am I saying that correctly?
Yeah, Carrot Digital is the digital asset mining arm of the company. And we had announced that we were spinning that off as well. At this stage, we are in discussion with strategic investors to come in as a pipe into that, prior to then looking at a spin out.
Got it. And then, the next question is in regards to your moat, your ability to get the favorable pricing that you mentioned on power in these certain geographies. Is that primarily just due to those locations, compared with relationships that allow you to uh, uh, get good agreements or favorable agreements? I guess what the question ultimately boils down to is what is your moat in terms of being an operator who can get these types of favorable uh, power pricings?
Yeah, Pat, I'll answer that. I wouldn't say the power pricings are, like preferable to us, right? It's about execution. Where we're very much focused on from a allocation standpoint is to pick regions whereby the power input cost is substantially lower. So, as an example, we're not going to go to Ireland, probably not going to go to UK, we're not going to go France and Germany. I think when you look at those regions, the power input cost can be anywhere from like 30 to 60 cents. Um, you will also have incredibly difficult political headwinds when it comes to the development of AI data centers. So if anyone followed the news today, a major data center application got rejected in Scotland. So we'd much rather prefer to focus on sovereigns who want to bet their future economy on digital infrastructure. So if I look at Europe, that's Norway, that's Denmark, that's Finland. It might not necessarily be Sweden, even though we're seeing some great opportunities in Sweden. It's certainly Abu Dhabi, Saudi, Qatar. Um, and then I could further go on in other parts of North and Southeast Asia as well. Where we're very much focused on is having a competitive advantage through connectivity at the upper sovereign level. So if we look at our portfolio today, that's been driven by some of our cornerstone shareholders that are coming into this current pipe, which includes members of royal families or huge conglomerate families within those countries where they have the political connections. Within Finland, that was a large part down to OGDC, where Philip von Wolfen had actually started investing in Finland 3 years ago. And he started buying up sites there with his own capital and put together a team on the ground. And Finland is a very nuanced market. So where you build your moat is actually on the people on the ground. So Finland, quite a parochial market in the sense that the people in the municipalities and within the power company, you got to be able to speak the language. You got to have personal relationships. So a lot of our team went to high school, college, etc., with the people in the power companies, etc. We're able to move into position to get those power agreements, and we were able to do that across like that. That entire portfolio is over 8 sites, and we will look to buy in the rest of that portfolio of the coming months. Um, And the input cost is really just a function of the country. So Finland is a very attractive market because it's like 99% renewable power coming from hydro, coming from wind. Their population occupies a tiny percentage of the overall land mass. So it's cold. They have an abundance of power, as I mentioned. It's cheap. They have fiber optic cables into mainland Europe. So it's an attractive market for us to enter. But we were able to enter through our political connections, both at the macro level and at the micro level in municipalities.
Excellent. We are low on time. There is one follow-up question we did receive regarding the carrot potential transaction, and that is namely, will a new record date need to be set in order to meet the distribution for carrot, given the delays?
Uh, the advice we've received is we don't have to set a new record date. What we're trying to engineer is the best outcome from a value creation standpoint. And similar to what's happened with Tembo, that involved, securing strategic pipe. We don't engage in structured pipe deals. We only want strategic. So at this stage, we don't expect a need to change the record date.